minutes presentation followed by panel discussion. And with that, I'd like to introduce our first speaker, Bekkers. Rick, you're working as a fiduciary manager fixed income for APG Asset Management.
Correct.
Your focus within fixed income is credits, but you're also involved in government bonds and EMD-related projects and topics.
Correct.
Go ahead.
Okay. Well, thank you, Jacco and Anne-Marie and the Society for this invitation.
You want to jump right in, right?
Yeah. Well, I'm on the edge.
I've got a few more feathers to
sure.
Right?
No, go ahead.
So your focus is on credit, but you're also involved in government bonds and EMD-related topics and projects. You have been involved since the early 1990s, so for quite some time, mainly within portfolio management roles for global fixed income portfolios. And before APG, you worked at a host of other companies, including AXA, Allianz, and Achmea, right?
Yes, correct.
So, that is a rich background and rich experience. So, Rick, welcome, first of all. And now I'm more than happy to hand over to you.
Again, Jacco, Anne-Marie, and the Society, thank you very much for this occasion. As we spoke just before the meeting, it is always one thing exciting to be able to be invited to host and to talk to you for 20 minutes on this specific area. It is, I mean, you mentioned mystifying the credit market, and I don't think it is maybe that much mystifying, but I do think that in the end, credits do have the different dimensions a bit more than equity, because it is not just the risk or the position on the credit curve or on the financing curve. I think there's a lot in there, and probably what I will be touching upon as well is of course because of the broadness of this market. I mean, we mentioned credits, and in that it is, if you look into this credit universe, which is so broad, you encounter very much different the different risks. Let me share with you some sheets I have prepared, and I hope it works. You all are aware to see them. And of course, this is the title. Well, and let me start by saying why I choose this picture on the first page. I'm absolutely no expert in fixed income or anything, or fixed income, Formula One, F1. That's but no expert in Formula One. But what I always enjoy watching when I look at Formula One is the pit stop. It makes me aware that this is something very crucial in the race. It is where I was still thinking that even with the speed of 5 or 6 seconds, you were able to exchange 4 tires and do a fill up on the gasoline. I just read that the team of Max Verstappen was able to change the tires in a world record of less than 2 seconds. So that's 21, 20, and even before 22, they did it. This means that these teams are continuously looking at the optimization of this process. And what I find very intriguing is how they do that, but also how they manage to mix the human factor, the human skill with all the technology in that industry. And I think it's in that sense it is very motivating to see how they are still able to improve on these processes. And I think it could be something worthwhile, or let's say the attitude to this change is something we probably we do share in the industry. I think we in the industry we do look every time to optimize further, and to see what is possible when you even when you believe it isn't possible anymore, because if you were at 3 seconds changing, that's already incredible, but then still believing that there are no boundaries. So that's for the picture, but let's say Formula One is exciting, but fixed income and credits is as well. I will share with you some of the sheets that I made. Again, these are very much bullet points. What I try to do is go through ahead and address some of the issues we run into on optimizing the pension fund portfolios of our clients. And let's say before we optimize, I think we start with the optimization. I think we have to look into the investment case for credits. Why credits? And credits is very much, and we're very much aware that the contribution to inflation hedging or the interest rate hedging isn't that big, so it's very limited. But in the end, I think there's certain characteristics of this market that make it very much a valuable asset class for pension funds. Bottom line, there's the attractive premium that is offered. As I mentioned before, credits are a very broad universe. I mean, we do have, let's say, on the lower risks, you have the government related, you have securitized, which maybe not offer that big premium. But on the other hand, what they do offer is very much a more liquidity or and a higher quality. Because bottom line, it is credit risk is looked upon as an alternative for the risk-free government bonds. That's where you have the bulk of your portfolio to make sure you are able to fulfill part of the obligations to your participant. So there we have the attractive risk premium. We have absolutely the diversification on total portfolio level. And central point is this broadness of this universe. We are very much aware that if you go to the higher yields, your correlations to equity is probably higher. If you're on the lower end, your correlation to treasuries is high as well. But the fact that you are able to distribute your investments over this total universe is delivering certainly diversification benefits to the portfolio. And as I mentioned, I mean, the quality, the limited risk, government related, is very much a part of the benefits for pension funds. And then looking at optimization, I think the optimization happens at different levels within the mandate of the pension funds. I think there's strategically, you want to give clients options on which what they would like to choose on and across what lines they would like to choose. So what I mentioned here and I show here is, for example, the discussion on investment grade high yield. I mean, this is typical topic on where you have to see where the risk appetite is and where you see what is the potential. If you would have no constraints, you probably would move to the higher end of a high yield because of the fact that the premiums are higher. But again, there's this mixture of investment grade and high yield where you have to discuss and how you have to see how you integrate it into your optimization, what levels work for your client. I think one of the other aspects is certainly is regional. I mean, the fact that in credits, I mean, we have a very large US market. We have already, again, also very large European market. I mean, there is certainly, let's say, even if you drill into the credit exposure or specific corporate exposure, you have benefits by adding the corporate sectors or very much locally oriented US corporates into such a portfolio. You have to have certainly a view on the currency, whether you choose it strategically or to hedge or not. These are all typical decisions you have to include into your optimizations, and these are typical decisions we do include into the optimizations when discussing this with our clients. I think that's, let's say, on the strategic, I think there's very much the investment grade high yield and regional exposure, which are very dominant. I think if you go a level below on the allocation to credits and that optimization on strategic level, we probably, if you move lower into the more portfolio mandating phase, there is certainly the discussion on liquid or illiquid and public and private. This is something we try to that happens in the optimization of portfolio at portfolio levels, because then again at that level you can have, once you have a risk budget allocated to your credit portfolio, you can sure see where you can broaden it. Typical is that these discussions and the room you give in a mandate are the potential sources of alpha that you can put into specific portfolios. Again, let's say going back to the strategic level, and that has to be decided within the ALM studies that we prepare for our clients, and the strategic allocations. I mean, the discussion on investment grade, high yield, are most dominant, and of the regionals. That's where the discussions are made. I think at that level, what is necessary for these optimizations to have the data availability. Very transparent benchmarks you can use to do your calculations and back to make sure that's to make sure that the data you have is available. When you go down, especially for public and private, there's less data availability. Although, I mean, we know that that's very much growing. Now, the pension fund market, I mean, this is certainly not an unconstrained market. There are absolutely constraints given the fact that if you're a pension fund, that you have to take into account. Especially, I think, for the minimum funding requirements. The minimum funding requirements, there are absolutely elements of the risk, the interest rate risk that you have to take into account, the credit risk. And if you move across the ocean and you include other credit markets which are not denominated in euros, you certainly have to take them into account. It's kind of, well, make sure that these effects do limit your potential. That's also given in the end the specific coverage ratio constraints. I mean, if you have a high coverage ratio towards your liability, you have more room to maneuver and to allocate within the different credit aspects of the universe. So that's very dependent on where the pension fund is when it comes to its coverage ratio. But that is clear. I think there's, I mean, in that sense, it is always, it does look sometimes a bit counterintuitive. The fact that when you have lower coverage ratios, you probably need more return and need to add some risk, but at that stage you're not allowed. So that's typical discussions that are going on. But in the end, that's the way it is right now, and that's what we have to live with. I think one maybe more obvious is, of course, the assets under management. I think you even you can have smaller assets under management, and then not every market within the credit universe is available to you. There are typical hurdles for minimum amounts to invest to make it valuable, or minimum allocations, and that's where we have to we take that into account as well for our clients. I think one of the other constraints that is not always that obvious, but is to make sure that there is an available governance budget. And that's typically something we discuss with our clients, that if you allocate to certain segments of the credit market, you do have to take into account that this is time. This can be time consuming. So this available governance budget for a pension fund board needs to be taken into account, that even if you see that a potential shift in your credit portfolio might add value, on the other hand, it would take so much time from the governance budget that it is maybe not worthwhile to maybe allocate it on a strategic level, but then allow maybe for some room in more, let's say, tactical level on within the mandate. And Jacco, you just touched upon it as well. I mean, market developments are very can be very determinant as well in this optimization. The low rate environment. I mean, we've been probably all attending quite some seminars where low for longer was the item, and again, I mean, we discussed this already for quite some time in the market. But specific for credit, I think what has changed since the last areas is, of course, the huge central bank buying, which has a large influence, especially in the investment grade universe. I mean, the Fed even hints and is a bit active in let's say more high yield as well. So this central bank buying is really affecting where the market is heading and how it is behaving. And we do have to take that account into our optimization, because what if we come into a period that this buying is over? What will that happen to our valuations? I mean, the lower spreads do affect the fact that it's maybe not as worthy anymore to invest in these credits. So I think that's really a topic that plays an important role in the optimization of your credit portfolio as well. And of course, I mean, law and regulatory changes. I think there's absolutely the effect that can have on the optimization of portfolio. So for pension funds, looking back, a great universe, plenty of value opportunities, very broad and absolutely valuable, adding value to a pension fund portfolio. But given the constraints, you have to be very much aware of what is happening. And for me, the bridge is law and regulatory changes, and that's a part of the discussion. Is the new challenges ahead? Where are we going to? I mean, as of 2026, we will be heading to a new pension contract, and this change will affect the optimization for the coming years as well. There's still a fair amount of uncertainty surrounding on what potential effect that would happen, but it will affect the optimization of creditors. So the fact that we move away from a nominal liability to available capital system, I mean, that is really a change, and not as maybe as much a change for the participant, because he will not receive or view his the amount that he might receive at the age when he will retire, but he will have this capital that is saved on his behalf. And I think very much the MFR constraints will no longer apply. So this will free up risk capital. Probably with pension funds who have a higher interest rates, it will free up capital. But certainly the global credit investors, and that's certainly applicable to the clients that I cover, is of course the fact that currency hedge is no longer maybe not the right word, but penalized as such. So this is really going to change. Now, how much of that capital will be available is of course is still unclear. I think what is new and what we have to take into consideration is that the risk tolerance and available risk budget is moving not much as from a collective level, but certainly also to the participant level. And that's going to be a very interesting discussion that we will be having for the next couple of years. Because I think we're all aware that the general participant has a low interest in his retirement and in his retirement plan. And that is something that has to be activated, because the fact that this is changing will affect absolutely the risk perception that we can apply to our portfolios. Because we know that there's a risk appetite difference between generations. The more we move towards our retirement date, we probably will tend to be less risk tolerant than when you're still young. But I think, and that is absolutely one of the areas we have to look into, the risk appetite that is within this life cycle or life cycle age bucket, as is mentioned. Are we really sure that every person between the age of 30 and 40 within this bucket has the same risk appetite? Are we sure that and we're not, because we still have to research it. But the fact that if once you're 35 or 40 and you see your available capital moving around, being very volatile, will you still be in the perception that you have to have a majority of your portfolio in shares, or do you get maybe less risk tolerant and want to move more into the fixed income assets, of which credit is one? So a lot of research to be done. I think very challenging times when it comes to optimization. I think we're still within the current framework, as I just showed. Yes, there are a lot of availabilities and there are constraints. We have to live with it for the next 4 or 5 years. But I think if we can have the same attitude as the Formula One, as the same attitude as the Formula One guys with their pit stop, and we have that, and we apply that same attitude for the next 5 years on this in this area, I'll think we'll come up with very good solutions and maintain the top positions that we have as pension system. But more important, I think that if we can get the participant more active towards his pension, and make sure that he's happy with his pension, because in general the attitude toward pension and pension funds is low. I think if we can reach that in these 4 or 5 years with this new system, I think we would have achieved probably a similar achievement as moving from 3 seconds for your pit stop to 2. That's so. Let's. This was part of the presentation. I think we'll have, if we have questions or anything, then of course we will do that later on. That's but I'll gladly hand the word to Gareth.
Thank you. I'll take that, Rick.
Sure.
Just bear with me 1 second, Gareth. Thank you for the presentation. So it's good to see that you're watching Formula One on television. The disappointments there every once in a while, but we do have this promise that one day in the not so distant future we'll have the first Dutch world champion. So you are gunning for making pensioners happy. I think that would be a great accomplishment. We may be happier as Dutch folks a bit earlier. Over to Gareth. Our next speaker indeed is Gareth, and Gareth, your surname is Isaac. Gareth is the head of multi-sector portfolio management for Invesco Fixed Income. Gareth is also senior Invesco Fixed Income investor in EMEA with primary responsibility for leading the global macro team in London. His brief also encompasses a wider investment and thought leadership role, working closely with the investment grade credit, high yield, emerging market, and credit analyst teams. Gareth is a member of Invesco Fixed Income investment strategy team, and his investment management and fixed income experience extend to almost 25 years working for organizations such as Schroders, Newton, AXA, Societe Generale, and GLG. So Gareth, that's a lot to tell. Welcome.
Great, thanks, Jacco. That was quite an introduction, and thanks, Rick, for setting the stage. So, good afternoon, everybody, and welcome to the presentation. I was asked to come along and give you the view from an investor's point of view. So, I think the one thing to relate to you here is that I'm looking at this and how we allocate risk across spread products within our portfolios. And I'm concentrating here just on a return maximization kind of point of view. From first principles, if you had a blank piece of paper and you're given X amount of $1 million, how would you invest that from stage one? So we run money for a range of different pension fund assets, amongst others, from very restricted ones to ones that are far more flexible, allowing a broader remit, if you like, in terms of how they invest across fixed income and currency markets as well. But we use the same framework, same investment framework to allocate risk across all those portfolios. So I'm looking at this from a kind of an unconstrained, sort of flexible type approach, as I said, starting from a blank piece of paper. So we're not looking at fixed maturities or yield targeting or liability matching, for example. This is purely for sort of return maximization. And it's a relatively simple framework. And I'll take you through it. And then at the end, I'll say how I think that investors should maybe, what you should maybe think about when looking at fixed income allocations. Because I think as Jacco said, I've been doing this sort of over 20 years now, coming in the 90s. And I've seen obviously a lot of transition within the fixed income markets during that time. I think this is easily the most challenging environment for fixed income investors. And as I go through this presentation briefly, I'll give you an idea of why that is. So just a few points that we have here, just how we allocate risk. So this is the framework that I'll go through. As I said, we don't have a huge amount of time. So it really is the sort of a 30,000 feet view of it. But hopefully I'll give you a flavor about how we do it and the investment process we have in place, where I think the opportunities are, and then some risks for the markets as we look forward to the coming years and quarters. So first of all, there are two main aspects of our risk allocation framework. So the first one is the macro view, our kind of top-down view, and how we build our overall level of risk within portfolios, and how the basis for our asset allocation comes around. So we look at growth, inflation, and financial conditions. Growth and inflation have been the cornerstones of fixed income investing for decades, but I think financial conditions are playing a far more greater role over the last 10 years, and I think with the advent of central banks and QE, that's likely to continue for some time. The second phase is how we look at each individual asset class and how we determine whether we want to invest in that particular asset class. We break that out into fundamentals, into valuations, and into technicals, and I'll go through those. And they're not equally weighted. And it depends where you are in the cycle, and it depends which is the biggest driver, which has the biggest influence over those three factors. But they're the three factors that we mainly look at when trying to equate valuation across different asset classes. Then we look at sector, and then we look at risk management, but this isn't for today's discussion, so I'll just concentrate on the first two. So as I said, the three key factors that drive asset prices, and it's the same across all asset prices, whether it's equities or real estate or commodities or fixed income, is growth, it's inflation, and more importantly now it's financial conditions. So I'm going to take a quick look at those now and see how they're stacking up as our top-down view of the world. So as you can see here, obviously it's been quite a extraordinary year as far as financial markets are concerned, with such a damaging health crisis across the globe. But when we look and we kind of take a step back at growth and where we've been and where we're looking to go ahead over the next sort of 12 to 18 months, and these charts were put together before we had the more positive news in terms of the COVID vaccines. But we were expecting anyway a pickup into 2021 and beyond. Central banks have been very accommodative, and we do feel that the support that they've given the economies, as well as an improvement in the overall global economy following an improvement in terms of the vaccine news, that we do expect to see a positive there. So when we just look at growth, we see that as a positive in both Europe and in the US and in emerging markets, but we can come on to that a little bit later. So the second key variable here is inflation. Now, obviously within the European Union and the European area, inflation has been quite difficult to generate for the ECB over a number of years. But the key for us in terms of growth is that we still look in terms of if you have strong growth and you have diminishing supply into that growth, you will generate inflation over the medium term. I think that kind of still holds. So our inflation expectations, even though we've had a significant fall in inflation this year across the globe, we do expect inflation to pick up next year, which we think will be positive for risk assets, moving away from this deflationary environment within Europe, embedding some risk premium into the yield curve, which we think will be quite positive. So when we take a step back, growth looks as if it's going to be improving, especially now that we've seen some of the reaction to the COVID news. Inflation still going to be low across the world, but an improving inflation picture away from deflation, so a steady low inflationary environment. Now, those two things together are very positive, I think, for risk assets. Now, finally, moving on to what I think is the biggest driver of financial assets at the moment, and this is financial conditions. So you can see the last 10 years or so, we haven't included the GFC into this or previous crises, but you can see in the last 10 years, there have been periods of sharp deterioration in financial conditions, and you can see the one that we've just recently had here as well. So this doesn't quite compare with the 2012 government crisis that we had in Europe, but it's been quite an extreme shock to financial conditions. And as we saw when we were here in March and April especially, we had significant widening of credit spreads, significant deterioration in economic outlook. And in fact, government bond yields actually began to rise when hedging of portfolios became an issue back in April. So financial conditions tightened aggressively. Central banks have come in, they've met that. And again, we started seeing a loosening in financial conditions. So from our macro view, growth looks relatively positive as we emerge from this health crisis. Inflation is likely to pick up, but not to an extent that's likely to worry central banks, and financial conditions, although they did tighten earlier in the year, have become a lot easier. Now, those to us, when we look at them as a top-down view, should be relatively positive for risk assets as we move into 2021. So that's the macro top-down view. Let's look at individual views on individual individual variables that I suggested. So fundamentals is the first one. So this is a chart put together by Citi, and you can see, I'm not sure how big your screens are looking on this, but as you can see, there's a lot of red on that screen. And this red signifies the percentage of corporates that are on watch to be downgraded by the rating agencies. So when we look at fundamentals, we look at the corporate health of companies across the world. And when we look at fundamentals now, obviously with the downturn we've seen in economies, the impact we've seen, especially in terms of the service sectors, corporate balance sheets look pretty horrible. We've seen a huge increase in terms of corporate supply in Europe and in the US to be able to continue to maintain the stability of many companies with a view that growth will come back. But actually, these balance sheets have deteriorated as leverage has picked up. So sales have fallen, revenues have fallen, debt is picking up, releveraging of companies, which actually, when you look at it in isolation, isn't a particularly positive sign for the fixed income markets. When we move forward to look at things like the high yield market, for example, we move away from downgrade risk because we don't believe there's going to be a huge move from investment grade to downgrade. But when we look at the high yield market, for example, here we look at default rates. So this is Moody's default rates, their expected default rates, and their default rates over the last sort of 20 years or so. You can see the big spike that we had just before the global financial crisis and post that. But high yield default rates have been relatively benign since then, and we kind of expect this to continue. We're looking at probably about 8% now in default rates, but they are relatively concentrated in areas of the market, such as energy, for example, where obviously the continuing doldrums of the oil price means that some of those companies are going to struggle. So this is the other part of the fundamentals we look at, the corporate health. So corporate health in terms of IG is deteriorating, even though we don't think there's a significant risk from IG to high yield. And then we look at high yield in isolation, we can see that default rates have picked up, but we do expect that they will be able to be managed relatively well into 2021 as we see a pickup in terms of global growth. So fundamentals aren't great. In fact, they're deteriorating across the board, but is this the key that's going to drive financial assets going forward? So when we look at the full opportunity set that we have, and I showed you there IG and high yield as two examples in terms of where we look at valuations across those two asset classes. But as a flexible investor, and as I said, so we're looking at this from an unconstrained asset allocation point of view, we can invest across all these asset classes. So here we have one of the quant models that we run at IFI, and this is built out by one of my team. And this looks through all of these particular indices, and we can split this out over different time periods. So you can see the one on the top here is over the last year or so, and the one below is over the last 3 years. So it depends what your time period is. It depends what your investment horizon is. But for this particular strategy that I'm showing you here, it's probably about 12 to 18 months. So we usually look at somewhere between 1 and 3 years. And you can see what's interesting. If you look at the spread over these periods, the huge rally that we've seen in these spread products over the last 1 year. Over the last 3 years, obviously, you can still see that many of these assets still are fair value, if you like, and there are still some asset classes which are showing cheap on the 3 year metric, but on the 1 year metric, we've had almost an entire about turn. So we came into the year relatively tight in terms of risk assets, especially in terms of IG and high yield. Had this huge expansion blow up in terms of spreads that we saw in March and April. Central banks have stepped in and we've seen a significant contraction in these asset classes again. So when we're now looking at where we want to be investing, having been heavily invested in March and April, when the valuations were very compelling and the technical picture was very compelling, we started to move out of assets such as IG, where we think that there are some signs that spreads are getting too tight, to move into the other parts of risk markets, such as emerging markets, where we think there are more opportunities. Now, for many pension funds, that isn't an opportunity set going into local market EM, for example. But for an unconstrained investor, where we can invest across the world, across different asset classes, to us on a risk-reward basis, that is beginning to look quite attractive. So the interesting thing is we use a number of metrics to work out whether we think asset classes are rich or cheap. And Z-score is one of them that we kind of have here. But we do stress it for a number of different time periods to make sure that we're looking at these types of assets over all the time periods that are necessary. Now, in terms of European spreads, and when we were looking previously, there was at the index. We break this down again. So if we look at European fixed income here, for example, as we are in Europe, and we look at a number of different measures in terms of the valuation. So we looked at the Z spread for the index, which is fine. So that gives you a guide of where you think particular indices are rich or cheap. And then you have to drill down a little bit deeper into that to look at the underneath, the actual constituents to see where there are attractive valuations. And here we're looking at the spread. So this is the spread versus government bonds across European and across sterling assets here. We've done it over 5, 10, and 15 years. So again, it depends on your time period. But I think the key here, and it's very simple to illustrate with this chart, is that fixed income assets on a spread basis are looking quite expensive. Now, we did see a sharp increase in terms of spreads in March and April, but a lot of that has come in now. So the key for us is when we're determining where we want to be invested, looking at the entire opportunity set, is whether we think that these spreads are likely to rally further, whether we think we're likely to maintain these current spreads, or whether we think there's a possibility for spreads to widen dramatically. And this is where we go back to our growth, inflation, financial conditions, where we think it's a benign environment. We think the growth will pick up. We think inflation is low and central banks are likely to keep financial conditions easy. So we don't see any material reason, especially with the advent of a vaccine, to see a significant pickup. So to us, this asset class does look attractive to investors, even though it may not be the most attractive asset class for unconstrained investors. And splitting these out again into high yield and into IG versus emerging markets, this is giving you the actual yield. Now, looking at spreads is one thing, and that gives you the spread, obviously relative to government bonds, but we're in a world where government bonds are yielding close to zero. So your all-in return for investors of these asset classes is significantly lower than it has been over the past 20 years ago. And you can see this, we're just showing this again over the last 10 years, they were close to the all-time lows in terms of all-in yield. So if you're an income-hungry investor, if, as I said, you're yield targeting or income targeting, it's a far more difficult proposition to be able to find a fixed income portfolio that's going to be able to meet those needs when yields are so low. And I think this is something to continue to consider when building out your fixed income portfolios. Now, moving on to the technicals, we've looked at fundamentals and we've looked at valuations. So the fundamentals, as I said, are pretty poor, whichever way you look at it, and we expect those fundamentals to remain pretty challenged for the foreseeable future. And we looked at valuations as well. And as we showed, valuations don't look particularly compelling, or at least they're not as compelling as they did earlier in the year. So if valuations aren't particularly compelling and fundamentals are looking pretty poor, why should you be looking to invest in spread assets at all? This is the reason. And I think this is something that Rick alluded to earlier. This is central bank balance sheets across the major central banks. I've taken the Bank of England out of this one, but they allocate, I think it's up to about 850 billion now. So you can see this is obviously since you look at up to 2008, central bank balance sheets played a relatively little part in terms of financial assets. They were there to smooth blips within disruption to the financing channels. But post the global financial crisis, central banks took a far more central view and central role in terms of managing liquidity and risk within financial assets. And you can see that even though you've had periods of strong growth in Europe and in the US and globally across this period, central bank balance sheets have continued to expand. They've continued with QE, and they've continued to support government and credit exposures and holdings over this period. And as we came into this crisis, we saw central banks increase quite dramatically their allocation to both credit and as Jacco was saying, the Federal Reserve is now buying high yield ETFs, which would have been unimaginable sort of 10 years ago. But now we're looking at central bank balance sheets of like 26 trillion. In my view, I think this trend is likely to continue. I think that now this genie has been let out of the bottle in terms of central banks being able to finance governments, which is what they're doing to a certain extent overtly within Europe, the UK, and in the US as well. I think it's going to be quite difficult for central banks to pull back and make governments develop an austerity programs to be able to make up the losses, make up the shortfalls from revenues. So this is the key driver of these markets. While central banks are buying, technical support is too strong, and financial assets are likely to remain relatively well supported. This is a quite an interesting chart. This just plots the Fed balance sheet against the S&P. I think it's fair to say that over the last 10 years or 12 years, any time that the S&P has begun to fall, the Fed has stepped up to provide verbal support and then actual support through additional QE to be able to support that market. That 26 trillion US dollars has gone somewhere. It's gone into property, it's gone into equity markets, it's gone into fixed income markets, and it does provide the bedrock and support for many asset classes. And it's very difficult to believe that central banks are likely to start reducing their balance sheets. The Fed tried it, and now they started increasing their balance sheets again. So with this technical bid to those assets, I still think that fixed income assets, even though they are quite stretched, the likelihood of a significant sell-off is very limited. And in terms of the ECB, so the ECB have been far more aggressive in terms of their bond buying program towards corporate bonds. They increased their pandemic bond buying program quite substantially, and we expect them to increase that again to by about another 500 billion as they meet next month. Then the ECB will continue to support not just European governments. We've seen that the Growth and Stability Pact, as the targets have been abandoned for 2021, I suspect that they're going to be abandoned for the next 2 or 3, 4 years. If you look at the IMF report they released a couple of weeks ago in terms of projected deficits for European countries, the expectation is that aside from 2 or 3 frugal countries, that budget deficits will be above 3% in Europe across the majority of EU countries out until 2025. The market's going to find it difficult to support that, so central banks are going to have to pick up the slack, which means that the technical bid for European assets is likely to remain in place. And finally, government bond yields are super low. So government bonds have depressed the yield curve. They brought interest rates down to 0. They pushed investors into different asset classes. And that's what we've seen. We've seen credit spreads incredibly tight. We've now seen all-in yields of credit falling to historic levels. And the grey bar you can see, or grey line you can see here, is Chinese government bonds, which still offer quite an attractive return for international investors. But if you look at the US, you look at the UK, you look at Germany and Italy here, there's a little bit of term premium if you push out to very long duration assets, but essentially you get negative or close to 0 on your government bonds, which for investors means there's only one alternative, which is to move further down the yield curve and further down the credit spectrum. And is that going to change? That's not going to change for some time. So this is the 3-year views. These are the 3 years implied policy objectives for major central banks. And you can see here that only 20 basis points of rate hikes are priced into the US over the next 3 years. That's not to say that more can't be priced in. It probably can be, and I think it probably will be as we move into 2021. If we can get a widespread vaccine for COVID and economies can begin to return to normal, there is so much stimulus within the global economy. Real rates are negative across most of the Western world, and governments are still able to support their economies. I think we could get a decent pickup in terms of growth. But the likelihood of interest rate rises in the US in the next couple of years, I think, is very low. Same to be said for Europe, where there's no rate hikes priced in for the next 3 years. So government bond yields are low, interest rates are low. They're likely to stay that way for a significant amount of time. Central banks are going to continue to buy both government and credit bonds, which means that that technical support will remain there. So even though fundamentals and valuations are poor, I would say, we can stay in this position for some considerable time. Now, one thing I will quickly just look at here in terms of these indices, and I think this is kind of key for us when we're looking, A, to how much level of risk we have on a top-down basis within our portfolios, and B, where we allocate those risks. And I think this is something that investors need to be aware of, even long-term investors. Here we have the average returns over the last 10 years of all of these asset classes and the drawdowns. And we have the current yields. But what is interesting in these box charts, you can see here, this is the range over the last 10 years or so of the lowest to the highest yield that we have seen. And then on the duration on the right-hand side, because I think this is something that many investors, obviously probably not in this particular call, but I think many investors generally would be quite surprised when they see how much the duration of many of these indices has changed over the last 4 or 5 years with continued government supply into this market. So if you look, for example, at global investment grade, you can see that we're at the lower end of those ranges in terms of 1.5% for an all-in yield, but the duration of these assets has extended quite dramatically to 7.5%. And the same can be said for Euro or USIG, is the investment grade all-in yields. These aren't spreads, all-in yields are very low, whereas durations have kind of moved out quite a lot. And the same can be said for things like global ag or or even things like Asian investment grade. So I think this is something that when you're timing your asset allocation decisions, and yeah, we can discuss the diversification benefits, for example, further in terms of a holistic portfolio, but just isolated in terms of the attractiveness of asset classes and the timing of doing those. That investors do take on board a great deal of interest rate risk at a time where yields or all-in yields are at their lowest end. So if you do see a period of higher growth and higher inflation, that's not a central view for next year. But if you do see one in 2022 and 23, and central banks do have to react, then I think that's something that investors kind of need to keep in mind when making long-term investment decisions. But I think this is quite an interesting chart, just to highlight where we are in terms of all-in yields and where we are in terms of duration. But just a quick view, even though we're saying here that high yield is at the bottom of its range and that that it's been cheaper at certain times, when you look at asset classes such as high yield, for example, and you can hold them for a very long period of time, you can see here there have been very few down years in the last 30 years for global high yield. So if you are a long-term investor and you're not particularly worried about each year and that performance, and you're willing to hold as an asset allocation decision, you are rewarded to be able to buy these asset classes with a long-term view. So just in conclusion here, as I wrap up, and we can move to some questions. We're relatively positive. We, as within our team, we came into the year a bit more nervous, and we're able to capitalize on the dislocations in March and April. But as we look forward now to 2021, we're relatively positive that growth is going to be a good year for growth once vaccines are taken on board. And I think it's going to be a good and positive year because there's so much stimulus in the economies. Having said that, we think that replicating returns you've seen from fixed income over the last 10 years, as I showed you in the previous chart, is going to be difficult. In fact, unless you see yields fall as much as they did, it's going to be almost mathematically impossible to do that. So I think investors need to be a little bit more cautious when looking at the medium term. And I think there are opportunities in global fixed income markets. I think there are within indices. So I was giving you an index level there. I think as we look forward to airlines and energy companies, for example, that have been hit acutely in this pandemic, they could perform very well if you see an improvement in terms of the global economy. We like high yielding assets. We like countries and economies that have negative real yields. We think they look kind of attractive to us in terms of risk budgeting, because we think those economies have a lot of stimulus and will perform well. And I think that this is a good example of we're active managers. I think that's the dispersion within some of these indices is quite extreme. And I think that active managers have been able to attack this pretty well in terms of the timing of this market, in terms of avoiding some of the more difficult market reactions that we've seen over the last year, but over the last sort of 5 or 6 years. And I think that that we're kind of well placed to be able to navigate what is probably going to be a more challenging kind of few years. So briefly on to, I've got quite an optimistic view. I think most of the asset classes we've kind of discussed will still continue to generate positive returns. There's a few risks here. The key one for us is inflation makes a comeback. With yields so low and duration so high, if central banks do need to tighten policy aggressively, it's not our near-term view, that would be pretty damaging for fixed income markets if there was a delay in the vaccine at all. And if, as we saw during the taper tantrum back with Ben Bernanke, if central banks even say that they're thinking of tightening, that can have a significant impact in terms of some of these risk markets. So I think central banks are going to need to traverse the next 2 or 3 years very carefully to maintain a balance of growth and stability within financial conditions, but also preparing the market for a time when inflation may be rising and that interest rates may need to rise from these rock bottom levels. So Jacco, that's it from me. in about 25 minutes there, just to give you an overview of what we do, and I will leave it there.
Great. Well, Gareth, thank you for presenting so far. Meanwhile, we have had 2 questions that I can see. I'll take them into the next session, which is the panel discussion. Starting off with a question that was raised by Dick Wenting, and would be good, Rick, if you could comment on that. Dick is asking, what is the role and effectiveness of credits in matching portfolios? And then in particular related to the new pension contract.
Yeah, I think it is hard to say that there's a role of credits as such. As I view the credit market as very broad. So within this, the broadness, then of course there are certainly the categories where you move into the government-related or even securitized part, or let's say the covered bond parts that can be highly effective for matching portfolios.
Will we still have matching portfolios?
Sorry?
Will we still have matching portfolios?
Ooh, well, yeah. Well, maybe not as we know it right now. But of course, yeah. I mean, there is this part of the investment return, even in the new contract, that is part with which it's called a sort of protective return in there. So. Yes, I mean there is still sensitivity to interest rate risk, and of course the interest rate sensitivity will be more in the, let's say, lifetime or life cycle buckets for the people moving from 45 to 65. So I think that will be there. So yes, high quality liquid credits do have a role, as they have now in matching portfolios. And I think that can be effective because in the end, it can help you just to make a bit more return than on the government bonds, as Gareth is saying. I mean, government yields, and let's say high grade government yields are close to zero or next to zero. And so we cannot expect that much from it. And these elements do give you just a bit more return to the portfolio. It is small, but yes, they can be effective and they will play a role in the future as well.
Yeah. Dick's question was also related to the beschermingsrendement, not so much to the matching portfolio. So I think with that you addressed it. Unless Dick, you have a follow-on, you can let me know in the chat. Then Jan Bekkers also has a question. Now, I'm simply not smart enough to get this. But maybe one or two of you get the question, and that is, do you also look at the relative risk budget and optimize that?
Yes. Yes, I think that if you look at the relative value of credits, then of course that is the optimization that is done on a strategic and ALM level. So credits has competition. I mean, it's not just government bonds and credits. There's quite some competition within the investment portfolio for a pension fund. It has to compete with infrastructure, real estate, equities. So yes, there is certainly within the strategic, the building blocks of the portfolio, credits has to compete. And I think what I would like to emphasize especially is that when we look back at this investment case for credits, I think that is the added value towards treasuries, towards government bonds. I mean, that's where you have probably a slight favor of credits within the portfolio. Once you have the allocation to your fixed income assets, I think there's probably a bias towards the credits elements of the portfolio.
All right, thank you. Gareth, for you a question, and that relates to you having made the case for active management. To me, with the divergence in containment measures and policy reactions by governments and central banks, this would signal differences from country to country. For instance, the China's rebound and successful containment of the finance compares very favorably with the likes of Brazil or Russia. Is this the time then for much more active management than we may be used to with here in the Netherlands?
So I think that when you have acute periods of stress that we've currently had, there are always winners and losers out of that. And I think that for active managers this year and the last few years, there have been opportunities to outperform the index, right? So quite significantly, I think. So I think that they're likely to go forward. I think in terms of we've kind of crossed the Rubicon here with central banks and financing governments. We actually heard from Andrew Bailey from the Bank of England. I think it might have been last month. Said that where the QE program is not swayed by government debt issuance. That's clearly nonsense. So it would be very difficult for the UK government to finance $500 billion of debt into the markets, right? Which is what this pandemic is going to cost. It's just not possible. So the central bank have to come and do that. So I think there's going to be unintended consequences from these huge support measures from central banks. And we're seeing it in the US, we're seeing it in Europe and Japan and China and the UK. And I think that does throw up kind of many opportunities. And I think that for active investors, not just in terms of multi-sector, but I think within credit, within high yield, for example, there are going to be significant winners and losers from that. And I do think that active managers can capitalize on that.
All right, great. A question from Steve who says, do you see liquidity risk or default risk as the bigger problem in 2021?
Yeah, so as we said, when we look to the Moody's projections, we're currently looking at about 8%, I think, in terms of default rates picking up. I suspect that if the vaccine and if the vaccine news is as positive as we've been led to believe, if that does start coming online in Q1, then I do think that with the support measures in place, and if you look at the furlough support measures, if you look at the support for small and medium-sized enterprises, you've seen it in Holland, you've seen it in Germany and France, for example, and in Italy as well. Governments have supported their economies incredibly well and funded by central banks. So default rates will be a lot lower than they would have been had you not had that support. And if we are moving into a period where global growth, which we think will rebound pretty aggressively, actually, and I think European growth with the stimulus in place could rebound very aggressively next year. So we don't think the default rates are going to move anywhere near that worst case scenario that I alluded to earlier.
All right, I'm going to challenge you then, but Rick is going to answer.
Okay.
if he feels like it, Rick. So I'll accept that. But the challenge is with markets being flooded with cash at the moment, demand you could envisage that outpace supply, giving lead to inflationary pressures, higher prices. Could we see more defaults as a result of that? And that is, undeserving companies that receive credit, so-called ghost companies that may become even more leveraged in this scenario when rates move up and ultimately result in a boom and bust cycle. Could that fundamentally undermine financial stability? Rick? 25 years.
Yes. Certainly. I think what as we have seen in the past, any move up in defaults, it's either reactive to a special crisis but does affect the stability. I think, but that's it is the flood of liquidity. Let's say on a total on the total asset category, I think where you're looking at is that specific corporate and of course the high yield sectors will be affected most. That's where it's gonna happen. But I do see that it will bottom line. The ghost companies you do. Those companies that are getting money right now that shouldn't, and it does put a lot of emphasis on the fundamental analysis skills that you have to make sure that you select very carefully which holdings you want to have in your portfolio. Absolutely, rising defaults will lead to more volatility, but I think the fact that you have active management and the fact that you have the abilities in place to select the right names in your portfolio, and of course, I mean, liquidity is part of a fundamental analysis as well of the positions of your corporates. So it will lead to instability, but with active management and the right fundamental analysis, I think you should be able to avoid the largest problems in that part.
All right. Yeah. Gareth, my proposition here that when things get worse, we'll have more defaults, but also when things go a lot better, we'll have inflationary pressures, rising rates, and hence more defaults. Could both be true at the same time?
Yeah, I think that my medium-term personal view is that we do reflate economies, but it won't be next year. So I think that for 2022 and beyond, I think with the level of support from central banks, level of support from governments, and real yields across the world, most of the world, very low or negative if you look in the US and Europe, that's incredibly stimulative for economies. If you look at the flows into things like money markets, for example, shows that investors have been very conservative throughout this. And if those flows move out of government bonds or short duration bonds or money markets into higher yielding opportunities, then I think that could spur growth quite substantially. For things like high yield companies, then that would be incredibly positive because high yield companies,
it inflates their debt.
It inflates their debt, but higher companies, they tend to go bust because their revenues fall and they just become insolvent. Where investment grade companies, their ability to roll over debt is quite what is important. And investment grade companies have termed out a lot of their debt. They've termed it out at very low levels. So I agree with you. There are a lot of zombie companies. That's probably why productivity has been so weak because of that. But I don't think inflation is going to be a problem next year. And even if you do get a pickup in inflation, the Fed, under their new regime, have said they're happy to tolerate inflation above the 2% target to make up for the time it's been below 2%. In Europe, in the euro area, negative inflation. So I think that Christine Lagarde would be absolutely delighted with seeing inflation move back above 1.5% as a validation of ECB policy. So I think next year, get the health crisis sorted, get vaccines out to those who need it, allow economies to reopen. Then I think you get a very strong period of growth. I think inflation remains low for some time. Central banks remain active to ensure there are no hiccups along the way. And I think that could be incredibly positive. However, does that stimulate inflation in 2 or 3 years' time? I think it probably does. But how willing are central banks going to be to slow that down when it's eating away at government debt over time and corporate debt? Then I think we'll have to wait until we get to those times to decide what they're going to do.
Do you have faith? Do you have faith the central banks will be able to manage the exit?
Well, they haven't so far. I mean, the Fed tried, didn't they? They tried to reduce their balance sheet, and they gave up on that pretty quickly when the equity market started falling.
Probably, I think that would be a bigger scare for the future. The fact that at some stage they have to, and we're not. They will not be able to manage this exit.
I don't think there's much likelihood of central banks reducing the nominal value of their balance sheets. I don't think that's going to happen. I don't think there's any desire to do that. I think one of the key risks, I think one of the changes we're likely to see is that countries have been running double-digit deficits, Italy, France, for example, Belgium, into this crisis, funded by the ECB. The populations of France and Italy and Spain will, if governments try to introduce austerity, I think will turn around and say, why are you doing that? Because we can issue debt, the ECB buy it. What's the problem with that? And I think one of the key risks is going forward is that you get politicians who decide that this is a policy to do this rather than an exception due to a panic. And I think that, you know, that's one of the key risks, I think, for the markets going forward, is that this becomes the norm. Christine Lagarde said today that it was exceptional, the PEP was exceptional, and that it was temporary. So we will see. We will see if it is exceptional and temporary, or whether, you know, they're still buying bonds in 2023 and beyond.
We have heard about extraordinary situations before. That's
exactly.
All right. There's hardly time for one more question, but we'll do one more question before we conclude on this this webinar. And the question is to both of you. Dutch institutional investors, especially pension funds, you know that, Rick, take a strategic ALM, strategic asset allocation approach to portfolio construction. And then credit may be allocated as a proportion of the overall budget. And within that allocation, the portfolio is usually sub-optimized. So let's say we do 10% in credit, and then for a 3-year period, we try to pick the best manager or the best assets. However, if you look at credit, certainly when it comes to private credit or private debt or alternative credit, it's a very, very, very diverse asset class. With various niches that have their own dynamics, and you alluded to that as well, Gareth. So my question is, and I think in an unconstrained portfolio you can do that much better, but how could a more dynamic investment style, where the best ideas compete for risk budget, be introduced in the Dutch market? You see that as a possibility, Rick?
Yes, I mean, I think we within the industry, I think that you should always aim for that kind of dynamics in a portfolio, and yet it is difficult. As you mentioned, I mean, if you review your horizon or your ALM studies every 3 years, how does that match with a dynamic, or let's say an allocation to more or less liquid parts of that of the portfolio, or the opportunities within credits? In the end, how should I? How can I phrase it? I don't say. In the end, there is already dynamics in this in the allocation, but whether I think we should really look into it is whether if the ALM or strategic studies are the area to have the kind of dynamism in the portfolio as you would have in unconstrained. I think there's where strategic and tactic move along. I think if being able, let's say on a strategic level, being able to have more illiquids, but then apply that very much to the mandate to deviate from the more standard portfolios. That's active management. That is specific alpha or excess return targets that you could apply on that level. But it is a true point. Reviewing every 3 years, and for investment classes that need horizons from 7 to 10, doesn't make sense, and that's is something that's maybe in the new pension contracts. There's still a lot of discussion on how to deal with illiquid investments, and probably we have more flexibility in that area to have some of that in the portfolios.
All right, thank you. We're overextending our welcome. I guess it's 17:19, so we're 4 minutes past the due time of this webinar, which is not too bad. I found it entertaining. At least I learned a couple of things when it comes to credit. And the one thing that I take comfort in is that a picture was sketched that is a bit more rosier than many of us may have expected. There's also the discussions around the typical constraints that we have in the Dutch market as institutional investors, be it insurance companies, but especially pension funds. these may be lifted to an extent, giving people access to asset classes that ultimately, Rick, as you should say, should make them happy, which is a nice way of putting our ambition as pension funds. Having said that, that brings us to the end of our webinar. And before I do, first and foremost, I would like to thank both Rick and Gareth for your presentations and your participation in the panel discussion.
You're welcome.
You're welcome. Thank you for your time, guys.
Thank you.
I'd also like to thank the staff at CFA VBA Society Netherlands, who have done a great job organizing the event. And of course, Tim Kruis and Invesco for sponsoring the event. Without Invesco, this time, without Gareth, of course, this may not have been possible. Leaves me with a few concluding remarks before we go. If you partake in the MiFID II CFA Society VBA Netherlands Stay Compliant program, it's good to know that all modules are available, and in order to stay compliant, you need to finalize those modules before the end of the year. Upon completion, Irma will send you a fantastic certificate. I already have it. I have it archived. It's ready for printout, and it will be on the wall behind me in a few more weeks, I guess. Also good to know that a CFA Society brushed off the old RBA program, and the new program started in September of this year and comprises of complementary executive learning with a modular certification. So do check that out. It is a highly recommended program and certification. Then a few words on upcoming events. We have a GIPS seminar on the updated GIPS standards on November 26th. So if that is your area of expertise, do go and get more detail on that. And then we have 2 skill-based Mondays that may be worth your while. The first one is on networking and is labeled How to Break the Ice and Feel Comfortable with Strangers, hosted by Chris Lemke of our Swiss CFA Society. And the second one on January 11th, also hosted by Chris Lemke, has to deal with real-time resilience. And with that, I'd like to thank you for your participation, and I wish you goodbye.
Goodbye. Thank you.
Bye-bye.